Pakistan's new federal budget elevates defense to a central pillar of state policy, funding roughly $9 billion in core defense spending, while the overall budget is trimmed and interest costs remain dominant. An equation that keeps development subdued and makes the model dependent on steady financing from markets and international financial institutions. Pakistan's fiscal year 2025-2026 budget is a statement of priorities. The government has raised core defense outlays to about $9 billion, a near 20% jump over the previous year, even as total federal spending is reduced to roughly $62 billion. This increase follows the sharpest military tensions with India in decades and is being justified as essential for deterrence and readiness. But it lands inside a budget architecture where interest payments consume almost half of all current expenditures, leaving little oxygen for growth-enhancing development and social services. The message is clear. Defense and debt service are ring-fenced. Everything else must adjust. Look at how the defense envelope is constructed. The $9 billion headline sits under Defense Affairs and Services, but it is not the whole story. Military pensions, about $2.6 billion, are budgeted under a separate pension line, not under the defense vote. Add those pensions to the core line, and the visible military-related burden is closer to $11.5 to $12 billion, before counting selective development allocations for strategic organizations and any off-budget or sensitive programs. The separation of these categories masks the total military footprint in the public narrative, even as the fiscal effect is the same. Fewer rupees for civilian development and social priorities. Inside the defense head, spending gravitates around four pillars. First is employee-related expenses, salaries, allowances, and benefits for uniformed personnel and civilian staff attached to the services. Second is operating expenses, fuel, rations, training, transport, spares, and medical support, recurring costs that rise with inflation and tempo of operations. Third is procurement of physical assets, weapons, munitions, vehicles, aircraft spares, communications, and air defense components, items that anchor capability refresh cycles and absorb foreign exchange when imported. Fourth is civil works, bases, logistics hubs, runways, depots, and housing, capital-heavy but politically durable once initiated. Historically, the Army absorbs the largest share, followed by the Air Force and Navy, with inter-services organizations taking the residual. That distribution reflects land-centric security pressures and the institutional size of the ground forces. Set that against the macro framework. Total federal expenditures are cut to about $62 billion, but current spending still dominates because interest payments sit near $29 billion. That singular number defines everything else. It pushes the federal public sector development program into a narrow corridor and forces rationing across subsidies, grants, and civilian operations. The government's revenue plan leans on higher tax collections and larger non-tax receipts, central bank profits, petroleum levies, dividends, to deliver a primary surplus consistent with International Monetary Fund targets. The deficit is slated to be financed by domestic borrowing and net external inflows. In practice, that means a continued reliance on Treasury bill and bond issuance, national savings schemes, and multilateral and bilateral support to close the gap. Consider the crowding out effect. When interest and defense together dominate the current budget, the development program becomes the balancing item. That means fewer new roads, irrigation upgrades, power transmission fixes, and water projects that drive productivity. Human capital investments, federal-level health and education commitments, suffer as well, especially given that provincial transfers under the National Finance Commission award constrain Islamabad's discretionary space. The net result is a low-growth equilibrium in which short-term macro stability objectives repeatedly preempt long-term capacity building. Over time, that erodes the revenue base, forcing the state to rely more on rate hikes and one-off measures rather than broadening the tax net through sustainable growth. Now imagine the financing shock scenario. If external loans slowed materially or stopped, the planned deficit would need to be met almost entirely in the domestic market or closed via abrupt expenditure cuts. History suggests the first reflex would be to slash the development program, dial down subsidies, and compress civilian operating budgets rather than reduce core defense or miss interest payments. Heavier domestic borrowing would raise yields, feeding back into even higher interest costs in the next cycle. That is the textbook debt interest spiral. Higher rates, higher service, less space for everything else, and more pressure to keep defense steady due to security imperatives. Breaking that loop without external inflows would require a dramatic revenue overperformance or politically difficult structural shifts in predicted heads, neither of which materializes quickly. The politics of presentation matter too. By placing pensions outside the defense head, the head line number appears leaner, but the underlying commitment is no less binding. Pensions are non-discretionary once granted. They index upward with pay scales and inflation and accumulate with each cohort that retires. Strategic and space-related lines, when shown within the development budget rather than the core defense vote, create the appearance of flexibility. Yet in practice, they are national security programs with strong institutional backing. Moving such lines up or down has limited macro effect because the bulk of fiscal rigidity sits in interest payments and the core defense operating base. The increase to around $9 billion is tied to recent security dynamics. Domestic policymakers have framed the budget as a response to the most serious confrontation with India in almost 30 years. That narrative binds the fiscal stance to a deterrence logic. The state must signal readiness, maintain operational tempo, and close perceived capability gaps. It also intersects with external partnerships and potential procurement pathways, including fighter aircraft, early warning systems, and air and missile defense enhancements. The funding of such acquisitions, foreign exchange, supplier credits, or phased payments, will test the budget's resilience, especially if external balances remain tight and international reserves need protection. The burden becomes clearer when looking at shares of the pie. Defense's proportion of federal expenditure rises as the total outlay shrinks. That is the arithmetic of austerity combined with protection of security spending. Meanwhile, gross financing needs are elevated by short debt maturities and rollover requirements, forcing a steady auction calendar and exposure to interest rate risk. Even with disinflation, the interest bill remains enormous because the debt stock and average cost are high. Without a long, credible glide path to lower rates and longer tenors, interest will continue to dominate the current budget and compress discretionary space. On the revenue side, the plan depends on higher tax administration efficiency and new measures. That includes stronger enforcement, closing exemptions, and tapping sectors historically undertaxed. Non-tax receipts add volatility because central bank profits and petroleum levies move with macro conditions and policy choices. If growth underperforms or enforcement lags, the deficit expands unless outlays are cut or additional borrowing is secured. In a year when defense is locked higher and interest is non-negotiable, the brunt of any adjustment would again fall on development and civilian services, compounding the growth constraint that the country needs to escape the debt trap. This is why analysts call the model unsustainable. A fiscal structure where interest and defense consume the lion's share of resources leaves insufficient room for investment that lifts productivity and expands the tax base organically. Repeated reliance on external programs and market rollovers keeps the system functional but fragile, susceptible to shocks in geopolitics, commodity prices, or market sentiment. The more the state depends on borrowing to preserve a large, recurrent defense operating footprint, the more interest claims grow, squeezing out the very spending that could catalyze durable expansion. It is a loop that requires a decisive pivot toward sustained growth, broader revenues, and a credible disinflation cum duration strategy for public debt, none of which are quick wins. The bottom line is stark. Pakistan can hold a military-related envelope in the $9 to $12 billion range only by pairing it with strict restraint in civilian development and significant borrowing. In the near term, the strategy hinges on continued access to external financing and the political capacity to maintain tight fiscal discipline. In the medium term, without stronger growth and deeper, broad-based revenues, the combination of high interest payments and elevated defense outlays will continue to suppress development, leaving the military burden fiscally heavy and the overall model difficult to sustain.